Holy smokes, Treasury liquidity is in absolute shambles, and some are wondering, is our Treasury market going bankrupt? Treasury Department's obviously a pretty big deal, and with yields as juicy as what we've been seeing, like today, the 10-year Treasury at 4.11%, absolute frickin' insanity, folks. Look at the peak of this summer. The peak of this summer has turned into a joke compared to what we're seeing now. This is crazy. And yet, even with rates this high, folks are worried that the Treasury market is becoming dysfunctional. In this video, we're going to talk about this dysfunctional Treasury market, what's happening, why it's happening, and what it means for us, because the Treasury Department is about to undertake something that they haven't done in over 20 years, harkening back to the dot-com bubble. That's right. Well, folks, let's get into it. This video, by the way, brought to you by Moomoo, but more on them later. All right, take a look at this. Treasury liquidity metrics last month reached the worst levels the market mayhem has seen since the onset of the pandemic. Yeah, and we had panic at the beginning of the pandemic, okay? So it is mind-blowing that we are seeing Treasury issues to the degree that we saw at the beginning of the pandemic, when rates were like nothing, okay? Then it was like, why would you buy Treasuries in this environment? Now it's like, dude, they're offering you 4%, and there's still not enough liquidity for these suckers. In fact, it's so bad that not only are we seeing metrics that suggest spreads are as high as they were in 2020, but you've got folks now saying things like this. You can drive a truck through the bid-ask spread for some of the Treasury securities, says the CIA of whatever, some company. Here's a chart to basically show you the madness, okay? So this was the beginning of 2020 right here, and it shows you how briefly we had a spike in the spreads for Treasury yields. Basically, the higher this chart is, the more liquidity problems you have. When you have a lot of liquidity, like a lot of cash, a lot of buying and selling going on, you generally have very, very low spreads, like all the way at the bottom of this chart over here. That's because the more transactions you have, the closer the market gets to where it should be, right? But when the market is like running out of buyers, you got some people selling, but you've actually got less transactions going on, and specifically people don't have as much cash as they used to, liquidity problems spike. Except they don't spike like they did in the COVID pandemic, where we had this sort of shock for a moment and we had a V-shaped recovery. They've grown. Look at this. The problems have been getting worse and worse, and the liquidity issues have been getting worse as yields have gone up, which is odd because more people should be wanting to buy Treasuries right now, but they're not. And they're not buying Treasuries because they think that inflation is so out of control that even at 4% Treasury yields, this could be a risk and this could be a bad deal because maybe next month they'll be offering us 5% on our Treasuries. How crazy could that be? But the point is, this chart go up, it signals problems in the Treasury market. It is a stress of cash and not enough liquidity. And so now the Treasury Department is coming out and doing something that they haven't come around and offered before. Reuters, US Treasury Department asks major banks if it should buy back bonds. Yeah, the Treasury Department is now considering doing something they haven't done since the dot-com bubble, and actually try to step in and provide liquidity for the bond market because it is so badly in shambles. And we are literally just now at the beginning of the quantitative tightening cycle. That's scary because that combines to this. So let me paint this picture for you, okay? You have the Treasury market and Treasury Department saying, hey, we'll sell you bonds. We'll pay you 4.1% on a 10-year risk-free. No risk for 10 years. Every year for the next 10 years, we'll pay you 4.1%. And guess what people are saying? Yeah, nah. Usually, the Federal Reserve would come in and buy. But see, the problem is the Fed's not buying anymore because the Fed has, well, they're not buying as much anymore because the Fed has now said it's time to roll off about $80 to $100 billion worth of treasuries a month. And so that means they're buying 80 potentially to $100 billion fewer treasuries than they ordinarily would have been. So the Federal Reserve is gone as a buyer. Other or banks are tapped in terms of how much they can borrow, and I'll show you, or how many bonds they can get by. So they're tapped, and I'll show you why in just a moment. Banks are tapped. And otherwise, companies and people are just out of cash. And pension funds are like, wait a minute, wait a second. Usually we'd be buying treasury bonds, but wait, what just happened in the United Kingdom? The Treasury Department had these juicy bonds that pension funds were buying. Pension funds would buy them, but then the value of those bonds would drop, and because pension funds are leveraged, they were getting margin called. So buying these risk-free treasuries is only risk-free to the point that you're buying them with cash. But if you're borrowing them and then they drop in value before they hit maturity, well, now you get margin called. So you actually have multiple institutions who are ordinarily buying treasuries that are not. The Fed's not buying. Banks can't buy anymore. People are out of money. Companies are like, we're probably wanting to use our cash to do cheap acquisitions, or we're running out of money too, and we got to tighten our belt because cash flow is about to go down because we're going into an earnings recession. And you got pension funds that are like, yeah, we don't want to get margin called like what happened in the United Kingdom. Even the Dutch market, which has way more leverage in the pension fund system than the United Kingdom, in the Netherlands, in Holland, they're like, oh, scheiße, this could be bad. Yeah. So why is the Treasury Department now suggesting, as Janet Yellen, well, maybe we could just buy our own bonds since nobody else is buying them? I don't know why all of a sudden she sounds like a sick version of Mickey Mouse. But I don't know. But we'll talk about those details and what they mean and what the Federal Reserve says is a danger about this. Right after I mentioned that, this is brought to you by Moomoo. One of the best trading platforms in town, Moomoo offers countless trading features to help you take your trading game to the next level. You should give Moomoo a shot specifically to try out the amazing and advanced technical analysis features they have. Some of their charts are some of the best. And if you sign up using my link down below, you will get up to 15 totally free stocks each, potentially worth as much as $2,000. That's almost up to $30,000 that you could get. And Moomoo is also available for the Australian audience. So if you're in the Outback and you want to learn some TA, check out my link down below. If you're in the States, also sign up via my link down below. Open a new Moomoo trading account. Get $10 cash back for every $100 you deposit, up to $50 of cash back. Plus, get those up to 15 free stocks. Terms and conditions apply, but of course, check out that link down below. So, back to the Treasury Department. What does this mean, folks? It means we're out of money. But we already talked about that. So, what is going on? Like, why aren't banks at least buying? Let's take a look at this. So the underlying cause of the lack of liquidity is A, the Fed, right? B, pension funds, C, companies and people, but also, banks, due to the SLR, don't worry so much about what that means, don't have the ability to buy more treasuries. So in other words, banks who are sitting on a lot of cash can't actually go shopping for these treasuries. But why would they? Because A, they can't via the SLR, but two, they don't need to. They can just park their money with the Federal Reserve in the reverse repo market, and they can let their money sit here. See, this right here is when the SLR requirements expired, and so then all of a sudden banks started putting their excess cash in here, and so we've seen that excess cash balloon. Well, the problem with this is now the Federal Reserve, and this is where it gets dirty, now the Federal Reserve is having to pay these insane interest rates on all of these bank deposits. So banks are like, hey, we don't need to take the risk and buy your stupid treasuries, even though technically they're risk-free assets. If we're levered up, then we have lots of risk because the value could drop in the short term if you don't hold to maturity, right? Instead, let's just collect a lot of money from the Federal Reserve. You know who's winning big here? It's the banks, folks. It ain't the people. It ain't the government. It's the banks, because the banks are collecting all this money. The more money the banks collect here means the less money the Treasury Department gets. And the less money the Treasury Department gets means the Treasury Department ends up going into more debt, which is interesting because now the Treasury Department is like, hey, let's buy back our own bonds, which maybe we can buy them back at a discount. But that means the Treasury Department is using more cash temporarily to try to pay less interest in the long term by buying back their own bonds, potentially at a discount. But again, potentially and ironically increasing their debt. Sure, they might have some benefit of not paying some of the higher interest and being able to buy back some of these bonds at a discount. But when does this end? And so this creates a very dislocating nightmare where some folks are just worried about the future of this. See, look at this. The Treasury Department carried out buybacks in 2002 was the most recent time. And some have been saying, hey, let's try that again. And the Federal Reserve Bank of New York has a staff report from 2007. These dates are great. .com bubble, Great Recession, whatever. Buybacks in Treasury market and debt management. And see, they actually think it's constructive. They actually like that, hey, during a time of budget surplus, which is the last time we did this in the early 2000s, let's use buybacks because you have extra cash. But we're in a huge budget deficit right now. So another big difference, we're in a huge budget deficit right now. Now the Fed says, hey, we think that if you buy back debt and then cancel that debt, you're paying less interest. We've done this before. We think that ultimately there could be a benefit to you buying back treasuries. So the conclusion, just wrapping up of their paper, is that, hey, we think even during a period of debt or deficit spending, there could be a benefit to buying back your own treasuries. But we've got a few problems. The first problem is actually outlined in that Fed report I just showed you. They say, the difficulty with strategic buybacks is knowing when to stop. That is, identifying the point past which further increases of the size of new issues conflict with the debt management objective of least cost financing. That's just a fancy way of saying, hey, if you buy back your own debt, maybe you're able to reduce your interest payments, but now you're kind of like, you're messing up the existing market. And we haven't done that before. So this is where things get really interesting. Because let's put these pieces of the puzzle together. Here's my bottom line to this. Now, this is my opinion. This is just my understanding. The Treasury Department is now using a tool they haven't used since the dot-com era. They last used it when we had a budget surplus. Now they're going to use it in a budget deficit using a 2007 paper from the Fed who says it should be okay. Okay, sounds good. Thanks. Now, it should be okay, which means temporarily Treasury buybacks should help provide liquidity and lower yields in the short term and increase bond prices. That's the theory. That's good. But what if it fails? What if the Treasury goes out and provides liquidity for 6 months or 3 months, whatever, and then all of a sudden it doesn't work? And yields continue to go up, bonds continue to fall in price, and spreads continue to widen, that chart I showed you earlier. Well, now it tells the market, the Treasury market took out a tool that they haven't used since the dot-com bubble, and it failed. That creates even more fear that the bond market is screwed, which could lead to even less bond buying, more bond selling, lower bond prices, higher yields. Now, the pension disaster that you saw in the United Kingdom could come to America, because now pension funds in America start getting margin called and they start dumping bonds. Now the Fed has to decide in America, which is a global precedent setter. Oh God, okay, now we have financial stability concerns in America. Do we keep hiking or do we bail out pension funds or let them go bankrupt? Remember, if pension funds go bankrupt, then the companies become responsible for paying the pensions of the employees who worked for those companies, which could lead to a disaster of earnings for those companies as they take massive write-downs, or those companies go bankrupt. And then the government has to bail them out anyway, which just creates more of a federal budget deficit. Every which way you slice this is the fact that the Treasury Department is coming out and starting to do this should be scary. It's a sign that things are getting so bad that Janet Yellen is trying to pull stuff out of a hat from the dot-com era, and we have no idea what's going to happen. Now, I gave one scenario of what could happen. The other scenario is that in 2 months, inflation could plummet to 4%, and stocks could moon, and bonds could rally, and yields could plummet, and everything's fine. You know, the tides just don't go out all the way. The other potential is you sign up for Moomoo via the link down below, and you leave a comment to let me know what your thoughts are. Because I don't know. But I will say, when I studied this over the last few days here and have now put this video together, I'm like, oh boy, I don't like the idea of reaching into a bag of experiments to see what'll happen. Let me know what you think. but Halloween is starting to look darker and darker.